In this episode, we'll be talking to a well-known finance expert to talk about the risks of valuations, the risk of what's going on in the war, what you can do to insulate yourself from an economy that is sclerotic, to use his terminology. Stay tuned.
This is Make Better Wealth Decisions, a podcast dedicated to helping pre-retirees and retirees manage risk and economic uncertainty by adopting a pension-style approach to improve your risk-return trade-off. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto.
So once again, we're speaking with Tom Sigfront, and Tom has been on before, and he's a great person to talk to because the world is changing very quickly, almost too quickly. And I wanted to get his take because it's something that is oftentimes very much respected, and I'd like to see what you think. So Tom, welcome back. And I'd like to begin by talking about the war that's going on in Iran and what it might mean for capital markets. We've talked before about how ratios are high, the CAPE ratio is high, valuations are high, and the war is still going on. And there are a lot of people, geopolitical commentators, Robert Pape at the University of Chicago, Peter Zion, a Canadian goes by the name of Dr. Zhang, who are all saying that we haven't really felt the knock-on effects. And I'm wondering what your view is with regard to what will happen when people start to really feel the bite of inflation, of maybe even shortages of food and of fuel and so forth. What do you think?
Well, I mean, I think right now, if we look at the markets and how they've reacted, you had a bit of a correction. People were worried about this. I think some of the markets are setting new highs. So the market's obviously discounting this. The reality is we have oil at, I think, pretty much in the high 90s, and it's starting to trade sideways. So it seems to be in some sort of equilibrium. That's high. I've done some work on oil prices, like specifically real oil prices, and they seem to correlate very highly with economic growth. So when oil is cheap, global growth tends to be high, and vice versa. Like right now, if we adjust for inflation, oil prices are high, but they're not super high. I think more to the point, I mean, if there's continuing to be bottlenecks, that could be a serious problem. You alluded to food prices, and that went on before the war started. We Canadians, we tend to complain about food prices for very good reasons, and we are having more food inflation than our Western counterparts. But I'm hearing these complaints everywhere, even in the United States, which is doing well. So when I look at economic productivity and kind of values, one of the things I do look at when people are talking about the affordability crisis, I will look at, for instance, what price it costs in a society to have a basket of goods, let's say a month worth of typical food, and how long it takes the median income person to earn enough money to buy that food. And, that's clearly going up. So you could say in terms of food, we are getting poorer, and that's going to be a concern. And we see that really in Canada, but we see that kind of all over the world because food prices tend to impact people at the sort of lower income levels because they spend a higher percentage of their money on food. And I think that is actually related to what we see in a lot of societies now, especially in Europe, with so much mass protests going on. I think it's a variety of issues, but I think, you're starting to see really social cohesion starting to fall apart in countries that I never saw in my life. And one thing I'll say about that sort of whole argument about productivity and how long it takes to buy food for a worker, I lived through the 70s. And one thing about the 70s is in, I think, a 13-year period, we had 4 recessions. We had inflation back then that it was far above what inflation is today in the Western world, except wages were going up too. So even though it was rocky, it was a very different situation than we have now, where we seem to have no recessions. We haven't had a legitimate recession since '08 because the COVID situation was self-inflicted, wasn't cyclical, but we don't seem to have any growth. And it's going to be interesting. And as you said, valuations are at all-time highs, the cap ratio, the Buffett indicator in the US. So we'll see. But on the other hand, this AI revolution is for real. It's, there's a lot of stuff out there on YouTube that it's a bubble. Well, first of all, how can it be a bubble? Because a lot of these companies don't even trade publicly, right? So they can't even get overvalued. But it's for real, and it's going to change things. It's going to be disruptive. A lot of people are going to lose their jobs, but there's going to be a lot of other jobs, and there's probably going to be more net production out of the world. So,
all right. So one of the things I didn't do is I didn't really properly introduce you off the top. So just so that people listening understand, Tom's a Toronto-based investment professional. He's got over 4 decades of experience. He's been an analyst. He's been a portfolio manager, a chief investment officer, strategist for a mutual fund and pension fund industry. He's a CFA and an MBA. You're a man who comes who knows of what he speaks when we talk about these things. Here's something that isn't talked about very much, and I don't know if you're feeling comfortable weighing in on this, but I'm wondering about these days. I'm wondering about the efficient market hypothesis and the things that we know. So, as I mentioned earlier, we have a very wide number of very highly respected, world-leading geopolitical strategists who say that it's pretty much baked in, that it's unambiguously certain that we're going to have a major recession as a result of this war because of the things that there's just a lag effect. And the efficient market hypothesis says that markets reflect all available information and they know what's going to happen and they react accordingly based on what's coming down the pike, even if it hasn't happened yet. But if that were the case, if the world truly understood that there's a major downturn coming because of the disruptions that are part and parcel with the war that is ongoing, why are markets still hitting new highs? I'm wondering if you've got a take on how that could even be possible.
Well, I've been hearing about the recession for a few years now. And, fair disclosure, I was one of the guys who thought at the beginning we would go into recession a few years ago. I based that on the fact that I was probably one of the early adopters of the yield curve theory, the inverted yield curve. Yeah. I did have a proviso on that insofar as the real rates mattered. Number one. Number two, we did come from a period of unusually low interest rates. If you believe John Grant's letter, and I do believe John Grant, it was like 3,000-year lows in interest rates. And that had an effect. So that, there was a bit of a delay. I think we're just in a different environment now. So I think we have less recessions, but we have far less growth. And we actually have falling living standards, which we've never really had before. Different periods of economic history are very different. So I think, as far as the efficient market hypothesis theory, I think it works with respect to stock picking. And I think it's even going to be more true now that we have AI that can calculate stuff so quickly. But, as far as the overall market, when we see, let's say, market crashes, right? If a company is worth $100 on Monday and the market crashes and it goes to $75, essentially, it didn't lose 25% of its value. It lost perception. So the market's shaped by perception. We've had this positive feedback loop where people just never lose money anymore, right? I mean, people just don't get wiped out. Every time there's a correction, it never really lasts. So I think that's the case. Now, the thing is about the cap ratios and the Buffett indicators is they're not very good at forecasting crashes, but they're very good at forecasting future returns for the next 5 to 10, maybe even 15 years. And what they're indicating is the equity returns are not going to be that great. I think as far as sort of this war, I think people are just so used to it now. It's such a chaotic world. I mean, since pretty much COVID and then the invasion of Ukraine and October 7th, people are just so used to it. I think on a geopolitical level, what I find is really interesting now is you're having the world definitely change right now. So this old NATO post-World War II alliance between especially Western Europe and America is starting to fall apart. They're actually no longer allies, or they're trending that way. I think they're becoming rivals. I think what's happening is you have two great powers. One's a little bit more chaotic. You have the United States, along with some of their allies like Israel, India to some extent, and Eastern Europe. And you have that on one side. I think South America's getting there. You have sort of the axis of chaos, or whatever you want to call them, Russia, the IRGC, and the Islamists, and China. And Europe is adopting a middle power. So if I'm going to get a little bit wonky into history now, Europe is kind of where the old Byzantine Empire is. And the Byzantine Empire, after Rome fell for most of its history, and it survived the Western Roman Empire by 1,000 years. But for most of that time, it was pretty weak. And it stood between, and it played off Catholic Europe against the caliphates. So I think that's what's happening now. So that's going to change a lot of things,
Okay, so one of the things I heard you say 5 minutes ago was that the 70s had 4 recessions.
Right.
And we don't really have recessions, or they're not very prolonged right now because of what's being done with monetary and fiscal policy. And we don't grow quickly, but we don't drop very much either.
Yeah.
To remind you, in 1979, the last time we had a really major bout of what might be called stagflation, it was because of an oil shock, because of what was going on in Iran. My view is that there's a reasonable chance that history may be repeating itself. It rhymes. It's not going to be verbatim.
Mm-hmm.
But the sense I get is that we're in a very similar situation in terms of what it means for the global economy. But what I find interesting is that people don't seem to recognize those similarities, which is to say they're skating through this as though there's nothing to see here,
Mm-hmm.
and there's no real reason to be concerned. And, the book that I have over my shoulder, Bullshift, I think this is what the industry is doing, is that it tells people, don't worry, everything will be fine. And as long as you can manage the perception to get people to believe that this time is different, and that just because that's what happened in the 70s, that's not going to happen now, the market, and this will go back to what you were saying with my question about the efficient market hypothesis, it seems as though the market is accepting the narrative of we're going to get through this, and that the oil shock is not really going to be a problem. And I'm wondering how much of that is spin based on the media picking up on the sound bites being put out of the White House in terms of, don't worry, we've got a peace deal, or we've got the concept of a deal, and we're on again and off again. But it seems as though the market doesn't think this war is going to be a forever war, that it doesn't think that it's going to go on in a protracted way. But all the people that know warfare say this is absolutely going to go on indefinitely, and Iran absolutely has the upper hand, and that means the Strait of Hormuz stays closed, and prices go up. So I'm having a difficult time figuring out what people should be thinking, and I'm especially concerned, given what you said a moment ago. Cyclically adjusted price earnings is trading at around 42 right now for the S&P 500. The Buffett ratio is around 230, all-time high for the S&P 500. So it may or may not be an AI bubble, but by any reasonable objective standard, the market is extremely expensive. And I don't
it's expensive. Yeah. I mean, one thing I would say about the war is I don't think Iran is winning, but I think it is going to take a lot longer than people hoped at the beginning for this to end. And it might conceivably end with the IRGC still in power. That's a real possibility. Eventually the straits will open. But the thing is, I mean, oil prices are high, and it's not a question of how high they are, it's how high they stay. If we're in a year from now, if oil prices are at these levels or around these levels or even higher, then I think that will have serious implications for the economy. I mean, I don't mean to be this sanguine about it, but I think crashes are kind of inevitable. You kind of You kind of expect them. They're random. You don't know whether they're going to be tomorrow. You don't know whether they're not going to be for 2 years, but eventually they show up. The analogy I'd use is, and I don't want to get too specific because, some of your listenership might be very all over the country and even the world.
Right.
But, we thought, we didn't think, but people thought condo prices in Toronto would never go down. And by any objective measure, they're a complete disaster. Like it's so bad that they can't even price condos anymore because nobody can sell and nobody can buy. It's a frozen market. I mean, it's equivalent to what happened after the 87 crash where they closed the market for, a bit. So, I think this is kind of inevitable that there's risks out there, but, they always take longer to happen than I would think. They're all,
Sure.
My track record for picking inflection points is a lot better at picking them than the timing,
Right.
So, I never know. Sometimes, it doesn't happen for years. And sometimes I'll be writing something and it'll literally happen, before I could even publish. So,
Yeah.
I think there's a lot of bad stuff happening out there.
Yeah.
And I also wouldn't discount the fact that we're just in such a sclerotic phase in the economy. So,
Right.
The thing that's, the good news is the crashes maybe are less likely. The bad news is it always, stinks. Right. Europe is clearly getting poorer. Canada is clearly getting poorer.
Right.
And that's never happened before.
Right.
So the Great Depression.
Yeah. So I can't help but think that there are certain things that they're really have no precedent. Thinking about, say, for instance, the debt level in the U.S., it's at $39.2 trillion now and growing by over $2 trillion a year.
Yeah.
And things like that. But it's, it's like the proverb of boiling the frog in the water. You can go on for a very long time. And we all agree that with that. But by the same token, it cannot go on forever. It cannot persist indefinitely. And so then the question that it begs is, so where exactly is the tipping point? And, all I know is that I'm more worried than I've ever been because these problems are more intractable and more pervasive than they've ever been. And I worry that people don't seem worried. Like when I see a CAPE of 42, historically, as you say, Bob Schiller says this himself, it's lousy for timing. But when the CAPE reading is 42, the return historically on an asset class that's trading at 42 times cyclically adjusted earnings is zero for a decade.
Yeah, I think your point about the debt is really valid. I think a lot of countries are in really dire situation. Well, not dire, but they're in serious situations. France has got a high debt to GDP ratio. The United States, if we adjust for the fact they don't fund their public pension liabilities like we do in Canada, when we started doing that, it was probably one of the only wise decisions we've made in the last 30 years in some ways. Mm-hmm. They're kind of at issue. Also, the Canadian consumer is in serious debt. It might happen, but I would say this, that I don't know what the crash, what's going to cause it if it happens, but it might be something out of left field. It might be that some bank that's a name brand bank has got, overnight liabilities that it can't pay, or, something dries up, or, just like Lehman Brothers, right? Lehman Brothers was a very respected organization, and then it just fell apart completely. So you never know how this is going to happen. But it's again, it's a very interesting situation because, I'm not used to a situation economically where you've had this kind of sclerotic activity where nothing, it's just deteriorating slowly. You had the 20th century where you had the boom bust cycle. During the period between the American Civil War and the progressive period, you had huge growth, but you had literally recessions that were so bad, people were starving to death in the United States. It was that bad. Now you're in a situation where it just bad. I think another thing we should be looking at, and this is for the long term, is the aging population. We're getting very old. The replacement rate is lower. There's less young people to buy securities and start saving. And quite frankly, they're poorer than we were on average. I mean, that, you know, the 21 to 35-year-olds are not going to be able to save the way our generation did because they're just not making enough money, and housing is too expensive. Also, as we age, the older population is going to start running down their savings to live. And that's going to create a lot of pressure on markets in terms of demand and supply. Because, I mean, I think Canada's, when the mutual fund boom started, and I was there at the Royal Bank when it started, it was like winning a major pension plan every week. It was so great. The average population in Canada was about 30 years. Now it's 40 years. And you have countries that are older, even older than us. Japan is like almost 10 years older than us now. So that's going to have an effect over the long term. But, you know, we'll see if there's a crash. I mean, we might just have the market go sideways for a bunch of years.
Sure.
I think also there is a risk that, and this is to the bond market, that governments are going to start deflating their way out of debt. I mean, the crucial thing in looking at debt is debt to GDP, right? One of the ways to decrease that, even if you have a deficit, is if you have you have real growth in the economy, which is kind of mediocre, but you can inflate your way out of it. I mean, if you have a balanced budget and you have 7% nominal growth, and let's say 1.5% of that is real growth and the rest is inflation, your debt to GDP ratio cuts in half in a decade. You know, that sounds great, but there's real implications to that with inflation. So, you know, there's some risks out there.
One of the things you mentioned is that you've got a pension background, and I'm curious about what a person can do. If you've got a pension plan, you're going to be better off than most, certainly if it's a defined benefit pension plan. But I'm wondering about what a typical Canadian investor can do in this sclerotic environment that you've just described that can maybe help insulate them from the challenges that we've been talking about, and maybe invest more, I would hope, like a pension plan, to smooth out the highs and lows to get a more stable return. What would you recommend an investor do maybe going forward compared to what they may have been doing, say, for the past 6 or 12 months?
Well, I would say start looking again at commodities, because commodities do insulate you from inflation to some extent. I would also look at income type of, like low volatility type of situations. I mean, people are still going to eat. Right. So grocery stores and things like that, anything that's sort of a consumer staple. And I would still put, believe it or not, I would still put some technology in there, especially on the AI side. One thing I would be cautious of Canadian investors is I would start, you know, if they haven't done so already, look outside Canada, because our index is basically financial institutions that are probably expensive right now. And if we do get some real consumer problems, they're going to struggle. I have a feeling that, you know, maybe some of their balance sheets aren't as great as maybe we would like, in the sense that, I can't believe they continue to rally, and, you know, people are losing their houses in Canada. So, I mean, that seems counterintuitive. And we also have, you know, you should still look at sort of our oil and gas and, you know, our right. mining and mineral companies. But, you know, as far as technology, I would go outside, because we're really not there. You know, there's no real technology plays. And this AI thing is going to be real. It's going to be disruptive, but there is, I think, opportunity there. So
perfect. Okay, thank you so much. This has been a wonderful conversation. I think we covered a lot of ground, and hopefully people will be able to take things away from this that'll make them better off and help them make better wealth decisions. So thank you for your time today, Tom.
My pleasure. It's interesting times we live in, but sure. You know, I kind of wish they were a little less interesting, to be honest. Okay, take care. Bye-bye. Thanks a lot.
If you're worried about the current investment climate in your money, go to my website to book a call for personalized advice to assist you in feeling secure and protected about your retirement.